Welcome to the Bitco podcast. My name is Nathan Stump. I'm the director of fintech sales here at the firm. We have Jessalyn from Ledgible, and we have Nick Fahrer from Forvis Mazars, if I said that correctly.
Yeah, that's perfect.
Let's get started real quick. Just a little bit about both of yourselves, your bit of your background, what got you into the space, and welcome to Wall Street here in New York City.
You want to go first?
Yeah, sure. First of all, thanks for having us. Excited to be here today. So I had a friend in 2014 tell me about Bitcoin. And whatever he told me about Bitcoin in 2014, he was so convicted, like, Bitcoin is going to be the next biggest thing. You have to invest in Bitcoin, blah, 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 blah. And in 2014, I looked into him dead in the eyes and I laughed in his face. I was like, you're crazy. This is not going anywhere. And finally, a couple of years later, I decided to sit down and do my own research to prove him wrong. And when I sat down to do my own research, it clicked. It all made sense to me. Like the sovereign ownership, the owning your own assets, the traceability, and the just all of it in general. And so whenever I learned all that information, I approached my firm, who I've been with for now going on 10 years, and said, I just learned all this information. And I think that there are folks in our firm that would, and clients that would find this interesting. And they, about 6 months later, took them a while to agree to let me write this article. But then they said, yeah, sure, you can write this article about Bitcoin.
Yeah.
Bitcoin at the time was obviously the largest market cap. And so then when you write an article, people then immediately think like, oh, you're an expert in the space, right? So
That's right.
right. And so then folks in the firm that had clients that were, in crypto started reaching out to me like, hey, I don't know anything about this. Can you help me out with clients in this space? And so I've been professionally helping clients with their tax and accounting issues in crypto since 2018. So been in the space quite a while and also super passionate about it and love working in the space every day.
I'll go next. I'm Jessalyn. I am the Vice President of Tax Information Reporting at Legible. And Legible is a tax and accounting software product for crypto and blockchain. My background is in tax. I've not been in blockchain as long as Nick, but one of the ways that I learned best is by touching and feeling things. So I really wanted to get involved in learning about blockchain, but I thought, well, one of the best ways to learn about it is to do it professionally. So my background was in general tax compliance. I used to prepare tax returns for people and companies way back in my early consulting days. And then around 2013, I started working with Oppenheimer Funds, which was acquired by Invesco a number of years ago. And I got into this space of tax information reporting, which is the 1099 world. And I fell in love with that, financial services. And it's funny because when I got that job, I was Googling what is a mutual fund in order to prepare for the interview. So I did not have a lot of imposter syndrome getting that job. Eventually, I went to go do consulting with PricewaterhouseCoopers.
Yeah.
Moved around to lots of different countries, became self-employed. And then around 2021, there was a job posting out on the internet to head up tax information reporting implementation, 1099 reporting at a top 10 major crypto exchange. So again, no imposter syndrome. I applied for that job, and that was my entry point into learning about crypto and blockchain. And this was about the time that the regulations were coming out that would first start requiring 1099 reporting on the sales of crypto and digital assets. So now I work with Legible on ensuring that our software and our products are fit for purpose for what the market needs for issuing 1099s with cost basis on them.
Yeah. 10 years almost at the same firm. One thing that's always interesting, I think, for, we're going to get into reporting, some specifics and what people should think about and what we see from both in this institutional, corporate, and maybe the individual side. But like 10 years at the same firm, you're doing other stuff. You're not crypto native in any capacity. Like, what's that journey like trying to get the firm to adjust? Because there are a lot of people that we talk to at major corporations or major companies that are like, hey, I want to try to get our company more crypto native, or we want to have a crypto strategy, but they're just old school and they don't really want to go down that path. I mean, what was it like trying to shift a little bit of dynamic? I know you're not maybe touching the underlying asset itself, but like getting them comfortable with being involved in the space, given there's a lot of things that's happened specifically with tax and accounting firms around different scandals that we've had over the last 5 years.
Yeah, it was definitely an uphill battle at first. Whenever I first started and wanted to get our firm to really buy in, it took a lot of persuading and education and the perception was at first is like, oh, well, this is only used for money laundering. This is only used by criminals. And I think that's the biggest hurdle first, is getting them to understand that the blockchain is fully transparent. It is traceable. If you're a criminal, like, that's probably the last place that you want to use.
Yeah.
Right. So getting them over that hurdle, educating them on the opportunities in the space, and that there are folks that are using crypto and digital assets for actual use cases, right? And not just the money laundering and the criminal activity, which is just a small portion of it. Frankly, what I had to do was I took to LinkedIn. Jessalyn and I are both very active on LinkedIn. And I thought to myself, where do people in this space hang out?
Yeah.
We're all online, right? Like,
Yeah.
whether it's LinkedIn or Twitter or Reddit, whatever it may be. So I try to create a presence on LinkedIn, online, where people could see me as the person to go to for as a resource in this area. Once they saw that, once I established myself, and then I started getting opportunities in the space that weren't just the random person that had maybe 100 transactions in the year. It was actually an institution or somebody that actually needed guidance on, oh, hey, we're issuing a token to our employees, and how do we handle this from a tax perspective?
Yeah.
Right. Actual use cases. Once I started winning work and to where they couldn't ignore it anymore, that's when I think they truly understood, like, oh, there actually is an opportunity here. This isn't just, somebody in their basement, trading, a couple hundred times during the year. Right.
Yeah. Yeah, it makes sense. So it's kind of creating the adoption or creating the buzz internally.
Yeah.
To move out. You're more crypto native. I mean, at least as a firm, you were Googling Oppenheimer, you're Googling Western Mutual Fund. I'm assuming now you Google what's the new layer 2 or what's the new layer 1.
I was Googling what is Ethereum yesterday. Yes.
Yeah. Okay. That's fair. From your perspective, like, you're more crypto native. You went from fund structure into this space. I mean, what's that journey been like from going from traditional finance, which a lot of us have? I went to Transamerica, into, with the seat you sit in now. And why crypto? I mean, like, why did you decide to leave Oppenheimer funds?
Well, so I left Oppenheimer funds because I wanted to move abroad and travel internationally, and there just weren't opportunities to do that with Oppenheimer funds. It was a fantastic company to work for. And the other thing is that when you are in traditional financial institutions, you have this mindset, at least, let's say from a tax 1099 perspective, they've been doing it for decades, since the 1980s.
Yep.
So if you come into this kind of company, there's established processes and procedures, and you're not really building anything from zero. You're largely just finding skeletons in the closet, fixing them, and improving processes and maybe improving software here and there. But when you get into crypto and blockchain, you are starting something effectively from zero. Now, I'm not talking like we're not launching tokens, we're not creating projects,
Yep.
but when I got this role at one of the top 10 crypto exchanges, it was like, we've never done 1099 reporting, and now we need to do it. You're setting up an operating model from 0 to 100, where traditional financial institutions have had 30, 40 years to do this. And that was one of our principal arguments, actually, we being Legible. We testified to the Internal Revenue Service when they first published the draft 1099 regulations, and we said, what are some of the problems with these regs? What are some of the timeline issues? And we said, look, a Schwab or a Fidelity had 40 years to get this stuff implemented in multiple phases. And now you're taking crypto companies and telling them you've got 2 years to do everything and squish it into this really tight time frame.
Yeah.
It's just not possible. So the attraction to crypto and blockchain was just sort of being at the ground zero, developing something. It's very, fun from a career perspective. You're not just cleaning up someone else's mistakes. You're actually just trying to get it right from the get-go.
Yeah.
So that's what really attracted me to getting into crypto and blockchain. And then specifically, with Ledgible, it's software. It's a startup kind of environment compared to, being in a financial institution for many decades. And so we get to touch so many different projects, which is very interesting and fun.
I mean, is that in the example you used, where you got 2 years to implement all these different things? Is that realistic? I mean,
No.
Yeah, based on what you see and the clients you guys talk to, like, is when we look at all these different reporting requirements that come out, we'll touch on 1090As versus a miss, and like kind of like what we need to think about, or what at least is kind of out there. I mean, is jamming all this down on the exchanges or the custodians or et cetera? Like, do you think this has been done before? We're just kind of fitting the square peg into the square hole, or is it like, listen, this is unrealistic expectations to some degree?
Absolutely unrealistic expectations.
Yeah.
But from the IRS perspective, they need to put some kind of guardrail down and tell everybody, do your best. And then usually right one day before the final deadline, they'll say, okay, we'll give you another year or two or however many it is.
Yeah.
It's absolutely not realistic from the perspective of needing to create onboarding procedures to document customers and collect their tax ID numbers and validate those tax ID numbers, then do tax withholding, automate that on a huge scale, calculate and track cost basis, and then issue 1099s at the end of the year, both to the IRS, but also a copy to the payee. Like, it's an incredible amount of work. And one of the biggest constraints is these institutions, like 1099 knowledge, what I do is already a very, very, very niche set of skills. But then finding someone that understands crypto and blockchain inside of 1099 expertise, there's like 20 people in the world.
Yeah.
And so the institutions not only have a compressed time frame to do it, but it's really unrealistic to get it done in that time frame when finding resources knowledgeable enough to implement and execute on the process is like a needle in a haystack.
Yeah. Yeah, I mean, I have a lot of personal friends who are degens, and for kind of define what degen means to me is like people who operate maybe more on chain. So versus just buying an asset on a centralized exchange, they take that asset, they move it over to a decentralized platform, and they transact. The number of times I get asked, hey, do you know any good accountants that can help me with this, is where you guys kind of fallen in, is like you can help bring all that data and pull it into a platform to help manage it. From an individual perspective, I mean, like we're all used to having a Schwab account or having a Fidelity account and getting that 1099 in the mail, and like it's accurate or it's got some good cost basis on it for the most part. Like, I'm buying this security, I'm selling this security. I mean, how do you see folks trying to handle this today when it comes to the fragmentation of information across if you move assets throughout the ecosystem?
It's almost, if you're a degen, right?
Yeah.
Like what you just said, it's almost impossible to report that information accurately on your tax return without one of these crypto accounting softwares. So without naming names, there's several out there, right? And some are better than others at certain things. None of them are perfect. There's always going to be something that's new in this industry because it's constantly evolving. It's evolving so fast. There's new chains, there's new tokens, there's all these different things that they have to keep up with. But there are ones out there that are 95 to 99% accurate, and you find the ones that work the best for you and make sure that you're connecting all of your exchanges and wallets. And that's how you can capture most of these things, right? There may be some manual things you have to go through and double check that the valuations are correct, or make sure that it's matching things up withdrawals and or transfers from one wallet to another. But if you don't have that and you're going out there and you're doing this all by hand, it's almost impossible.
Yeah.
Especially, as the volume of transactions go up and up, it just becomes increasingly difficult. And I think we're past this now, but I think one of the misunderstandings at first in crypto was that, as long as I don't settle back to US dollars, then I don't have to report anything.
Yep.
I think most people understand now that
Not true.
yeah, is not true. Yeah, that you do have to report crypto to crypto transactions. And that's where a lot of these crypto accounting softwares come into play and really help out.
I mean, it's difficult. If I move an asset into a self-hosted wallet, connect to a DEX, I'll sell, let's say I'm selling Solana for pick a meme coin, and I sell back to Solana, and then I go ahead and go from Solana back into a different meme coin. I mean, you have like 4 different transactions there because you have to recognize the cost basis from sold to the meme back to the sold to back to the new meme. And like, it's not like if you exit the Solana position at any potentially, just using that chain, for example, because that's where we see a lot of that activity happening. Like, there's a lot of reporting that actually going on in that transaction or in that flow of trades. So you're executing essentially 2 trades, executing one on the selling one asset, buying another, but there's like 4 different events happening.
No, you're exactly right. And I think sometimes people try to take a practical approach if they don't want, if it's impossible or nearly impossible for them to calculate and go through all those different transactions. Like, okay, how much money went in, how much money came out?
Yeah.
Take the difference, and that could be your net gain or loss,
Sure.
right? If it's nearly impossible to calculate all those in betweens.
Yeah.
Right.
There was a webinar that Nick and I recently did together where we had this slide. I think it was the last slide. We jam-packed all these bullets in there that listed out all these situations where even when you start getting 1099s, Here's all the different situations where you're actually not going to get a 1099 or it's incomplete. It's going to have proceeds but no basis. And the list is extensive.
Yep.
And the reason I mention this is we've been here before. Back in 2011 is when cost basis first started being reported on 1099s for traditional securities. So your Schwabs, your Fidelities first needed to report basis. Before that, they just reported proceeds, like the fair market value when you sold it. So back in 2011, those first few years after those rules were implemented, it sucked.
Yep.
Like the reconciliation effort was awful, trying to reconcile all the old records that people had been keeping themselves with the 1099s that they were getting. It wasn't fun. Over the years, though, it eventually smooths out. All the record keeping smooths out. You've sold off the assets that were messy. We're going to have the same thing. It's going to be painful. But the dangerous thing in my mind is with securities, largely everything kind of fell under the umbrella of getting a 1099. Whereas with digital assets, crypto, blockchain, there's a lot of stuff that falls out, or it's like you're going to get half the information, but not all of it. And I think that a lot of taxpayers, at least let's say retail investors, are going to be lulled into this sense of security that if I got a 1099, great. If I didn't, I don't need to do anything. Or they just forget about the stuff they didn't get a 1099 for. And there's just a lot of things they're not going to get 1099s for that they still need to report, even if there might not be a gain or loss. And so I think that's kind of like a little dangerous zone that's unique to crypto and blockchain that we would have had less of in TradFi.
All right, walk us through a little bit. I mean, to your point, 11, you go to 2011 and these changes on the traditional assets. Now who we are in 2025. Walk us through a little bit what the last few years have been required, and then what people are trying to think about this year, and I know the next couple.
So I think we call it the past. It was very chaotic. You either
Chaotic now.
chaotic now, chaotic then.
It's always
Going to be a chaotic for a few years. Yeah. But taxpayers didn't have any even crypto tax software at first. It was just like Nick said, they didn't even know if things were taxable or not. Then we started getting software that taxpayers could use.
Yep.
But then we started getting some exchanges issuing 1099s for some sales and exchanges, but not others. Some exchanges did it, some didn't. Some would issue them on weird kinds of 1099s that would confuse taxpayers and confuse the IRS. And then people would complain and then they would stop doing it. And then we arrived to maybe the last 2 or 3 years and industry practices have smoothed out.
Yep.
So you've got some traditional financial institutions that will issue 1099s, 1099B for sales and exchanges of digital assets, but they won't report basis. It's just proceeds, fair market value. And you have where you have centralized exchanges that offer staking services, we're seeing some 1099 miscellaneouses to report the income from those events. But it's still not widespread. Not every exchange does it because, again, they might not have the expertise to know that they should be doing it.
Mm-hmm.
And so for the last few years, that's been stable because the IRS proposed these 1099 reporting rules. So knowing that you need to implement some stuff in the near future, you're not going to start suddenly doing anything differently. You're just going to maintain until you need to change over to this new 1099 reporting regime. So today, let's say we're March 2025, people are getting 1099s for their 2024 activities. And they might be getting a 1099B to report proceeds. There's no basis. They might get some 1099 miscellaneous, reporting them some income like staking rewards. But any off-exchange activity, DeFi within their own wallets, there's still definitely no 1099 reporting. And then the next few years is going to be this transition to this new 1099, the DA, which will report sales and exchanges of digital assets, which includes both native crypto tokens, but also tokenized financial products, which gets really weird when we're talking about a tokenized equity that's been reportable on a 1099B for a very long time under the 2011 rules.
And what about your point?
Yeah, so I like to dive into, like, if I'm the degen, right? And I'm trading, Solana to your meme coin. Let's go back to that example. What does this mean for me? So basically starting on January 1st of 2025, so just a few weeks ago, right? Any transaction that occurred within a broker, which Jessalyn can define way better than I can, But I like to think of it as like your Coinbases, your Krakens, those types of centralized exchanges that are facilitating trades on your behalf. They're going to be issuing you a 1099 for those transactions on their platform. So let's say I, buy Ethereum and trade it for Solana on Coinbase. I'm going to get a 1099 for that transaction.
Yeah.
But they're not going to report cost basis on that. They don't have to report cost basis on that. If I send it off the exchange to a non-custodial wallet, connect it to a DEX and perform trades there, those transactions are not covered. There's likely going to not be any 1099s that happen for that, at least for 2025 and 2026. Maybe 2027 and going
So we're going to issue the 1099 in that example. That's the problem. Right?
Yeah, I
Like,
mean,
you have a smart contract that's essentially what some sort of the DeFi protocol, which typically isn't even US based.
well, so I mean, if you think of Uniswap as an
Yeah.
example, right? Like they might be decentralized, but they're also a team that works at and for Uniswap, right? So the argument is if they still have control over the software to make adjustments to the software, then they could make adjustments to capture that KYC information to then ultimately issue 1099s to the people that are using Uniswap.
This is the argument of the IRS.
Yeah. This is not my
Or not our personal views.
The broker piece has been controversial for years
has.
now.
Yeah. The House and the Senate actually just passed a repeal of the rules for DeFi only, not those centralized brokers that we just talked about, or like Coinbase and Kraken. And it's going to the president's desk, and they've already signaled that they're going to repeal it as well. So that's the last step. So theoretically, the DeFi world won't have to issue 1099.
The true DeFis.
Yeah, the true DeFis. Now, I know there are edge cases that you could probably speak to that may still have to issue 1099s. Do you want to speak to that?
So we use the phrase Dino, DeFi in name only.
Yep.
Like DeFi decentralized is a really good marketing tactic, but when you look under the hood and you look at terms and conditions, which I've become very good at reading terms and conditions. I'm not a lawyer. I write and I talk like one, but reading terms and conditions is really important for determining, are you a broker or not?
Yeah.
And there's a lot of dinos out there that say we're decentralized from a marketing perspective. But when you look under the hood, if they fit under the definition of a broker from sort of the earlier definitions, then this whole repeal by the House and the Senate and Trump is irrelevant to them. And the key example is in the broker definitions, there's actually no reference to centralized or decentralized. Those words mean nothing in the Internal Revenue Service. The definition of broker says if you're an agent to the transaction or a principal to the transaction or a payment processor to the transaction, and there's a couple others, then you're a broker. It was only if you were none of those did the IRS try to pull in this last one, which is a trading front-end services, which was meant to capture all these like true DeFis.
Yeah.
So if you're a DeFi in name only and you are an agent, principal, or a payment processor, you could still be in scope of being a broker. So it's important to mention that we call them the DeFi broker regs and the centralized broker regs for ease of reference, because me spouting off, are you a digital asset middleman who is a trading front-end service is word salad.
Yep.
And
no one's going to say it.
And no one's going to say that. So, the other thing I say about this is 1099s are not tax law.
Yeah.
It is just a reporting mechanism. If you don't get a 1099 as a taxpayer, you still have to pick up the transaction, report it, and pay tax on it if it's a taxable event. The 1099 is just the IRS's way of tracking you down if you don't do that. And so if you are a person who is trying to be tax compliant and report everything, then not getting a 1099 kind of is annoying. There's, we could debate pros and cons of getting a 1099 or not. But I'm sure the people that are trying to intentionally avoid reporting their taxes would certainly celebrate DeFi getting pulled back out of scope. And obviously DeFi platforms, it's an incredible burden operationally, finding resources financially to implement these rules. So it's of course, beneficial to not need to comply with them if they are true DeFi.
I mean, there's a lot of intelligent people at the iOS, but there's also a lot of rhetoric around laying off and people at the iOS. So like these sort of unique and sort of very complex strategies and ideas, like is there going back to the question of how quickly we're moving, like is we able to enforce all this? And now I'll preface that obviously everybody should be doing the right thing, but for how much and how unique it is it what rules we have to figure out, or how do we actually implement these sort of things if we go out when I was past this broker piece is extremely complex, and to your point, impacts millions and millions and millions of transactions. Can we enforce it, or should we just make sure we get the frameworks right and then implement the rules? I mean, what's the thought process a little?
So the thought process of the IRS, because there's been many arguments presented to them that say you don't have the infrastructure, the data processing infrastructure, to even do anything with the data that you're going to get on these 1099s.
Yeah.
And now, especially with all these layoffs, you're not going to have the human resources to do anything with it.
And obviously, we all should be reporting what we're doing.
Right.
But
so just generally, what does it mean?
So even for the IRS to look at it and say, how do we actually decipher all this information?
Their perspective, and again, I'm not IRS, I'm just, from my expertise, having done this in TradFi and now moving it into crypto and blockchain, is the IRS is never really going to accept the argument that these arguments that they don't have enough people and they don't have the data processing to do anything with it. Their position is, we need to get these rules in place as soon as possible so we can start collecting the information. So once we do have the technology and the resources to review it, we at least have the data to be able to go back and look for it.
Yeah, makes sense.
So, the arguments of them being able to do anything with it, it's largely not going to change the timeframes. But yes, I certainly think that the reduction in the resources is going to greatly impact their ability to do something with this stuff. But I don't think that it doesn't change anything about the brokers trying to do their best to implement the rules, and it shouldn't change anything for the taxpayer as well. Like, you report and you pay your tax if you're an honest taxpayer, and if you're not an honest taxpayer, well, then you're probably not listening to this episode, and you probably weren't doing anything with your tax reporting to begin with.
Yeah, here's what I would like to say is that, generally speaking, there's a 3-year statute of limitations if you're a taxpayer and you file a tax return for the IRS to open up for audit, right? So they can, if you file a 2024 tax return in 2025, have up until 2028, 3 years after you file your tax return or the due date, to open you up for audit. If you file a fraudulent tax return and you don't report your income, your gain or loss, things like that, there is an unlimited statute of limitations.
Yeah.
So they can open you up for audit at any point in the future.
Yeah, makes sense.
So regardless if they have the resources now, they may have the resources in the future, or the technology in the future to go back and open you up for audit.
I think that's important because, it's a lot of work, and there's a lot of people says, listen, maybe the transaction value wasn't very high and it wasn't high enough. And they're like, I'm not going to worry about it. But to your point, you still need to spend the time to go through the process and understand what you owe or what you need to do, because to your point, it might not have been a lot, but there could be more in time, unlimited down the road, that they could go back and look at it, and you're just opening yourself up to a lot of liability there.
There was actually just a taxpayer at the end of 2024 that was convicted and is sentenced to 2 years in prison because he didn't report a $3.7 million gain on his Bitcoin. $3.7 million. In the grand scheme of things, to me, that's not a whole lot of money going to prison for 2 years, because he's also going to have to pay fines and penalties and pay that back.
Yeah.
Right. So was it really worth not reporting $3.7 million and paying your tax on that? It'd go to prison for 2 years.
Let's talk a little bit, because we are just in essence of time, staking, because staking has been also very important. Talk a little bit about staking, the difference between trading and staking an asset, what that means from a reporting perspective, and just kind of how people should think about that.
Do you want to start with the tax?
Yeah.
Basic tax.
So from a taxpayer's perspective, there's generally 2 different ways that you can report this. The IRS has released guidance saying that staking rewards is income at the fair market value at the time that you receive it. The guidance they provided is not binding to taxpayers. So you could theoretically take a different position than the IRS has released guidance on. And that second position is that it's self-created property, that when you earn those staking rewards, the Coinbase rewards, if you will, the newly minted tokens that are part of the protocol mint, are self-created property, similar to a baker baking a cake. When a baker bakes a cake, they don't realize income when the cake comes out of the oven.
Mm-hmm.
They realize income when they later sell the cake.
Yeah.
So the same analogy could be applied here to the staking rewards.
Just hopefully the same day.
Yeah. It is that when you earn those staking rewards. It's like baking a cake. You just self-created property. You don't actually report that as income on your tax return until you later sell it.
Gotcha.
And there is a very strong position that you could take that on your tax return. It's uncertain. So we don't know for 100% certainty that you could actually take that position until we get guidance from Congress or it's litigated in the courts. But there's definitely a strong position that you could take that position.
Jessalyn.
And from the 1099 perspective, back to an earlier point, 1099s don't determine when something is taxable. You and I were kind of talking about this earlier. There's a big difference between institutional versus retail staking, for example, because when you are a natural human being, we are cash basis taxpayers, which means we largely pay tax when we've received the income, when we have the unfettered right to that income. But institutions might have an accrual basis, which is nerdy accounting terms we won't get into, but it means that its taxability could change from year to year when you compare it to a natural person, which means that an institution, if they get a 1099, that income may not actually be taxable to them in that year. It might be a future year or vice versa. So a lot of institutions might get 1099s for staking rewards when they've done it at a centralized exchange, like a Coinbase as an example. But it's really a reconciliation exercise for them to say, I got a 1099, now I'm going to reverse it out and report the correct amount of staking rewards that apply to my accounting method. With the natural human taxpayer, I think that there's some misunderstanding from the general human population, which is understandable. They're not tax experts like we are. There are people that think incorrectly that, oh, I earned a staking reward on Coinbase, but I haven't withdrawn it. I didn't click the button to take the reward.
Yeah.
So I can just not push the button. And I'm not saying that's a Coinbase feature, but if I just don't touch it, it's not taxable income to me until I push the button.
Yep.
The IRS has caught on to that idea many, many years ago. People would get a paper check in the mail and they'd wait to deposit it and say, oh, I just pushed it off into the future tax year. That's not a thing. The IRS says when the institution has credited it to your account and you have unfettered access to it, you just choosing to push the button doesn't change that it's taxable in the year they put it in your account. So taxpayers sometimes get surprised when they get a 1099 for something that they haven't actually withdrawn or taken into their wallet. And they'll contact the exchanges and say, hey, this 1099 is wrong, fix it. And the exchange will say, sorry, this is the correct 1099. It's up to you to deal with your tax advisor. So that's kind of the lay of the land with the staking rewards. And again, I mentioned earlier, not every exchange issues 1099s. Many of them do. It's sort of the biggest players. Not every major exchange offers staking reward services anymore anyway. And certainly if you're staking on chain and you're not using a centralized provider, you're definitely not getting a 1099 for that. And it's up to you to self-report it.
Yeah. I don't know if we said this or not, but I feel like it's worth clarifying that none of this is tax advice.
100%.
We've been talking about some things that could be construed as tax advice, so just want to make that very clear that none of this is tax advice.
Educational purposes only.
Yeah. Not financial advice. Just kind of as we think about wrapping this up a little bit, I think it's been really interesting. We kind of delve a little bit more fun into how how people should think about this. Obviously, this is not tax advice, but you guys are all professionals, and it's things that people need, including myself, need to think about as relates to not only last year, but how do I think about managing assets this year. Anything, just guys, closing thoughts as relates to either your firm, what you guys are focused on, and kind of things that we should look at for 2025.
Yeah, so a little bit of background about Forvis Mazars. We're a top 10 CPA firm in the US, also have a global network in over 100 different countries. So as crypto and digital assets goes global, we have the resources that can help in many different countries. What we're currently looking at from a tax perspective and the 1099 perspective is that there's a lot of holes in these 1099 regs. What brokers may be reporting to taxpayers won't capture the full picture.
Yeah.
So you're still going to need an advisor to help you, and you're likely going to need an advisor that you can rely on that understands these rules and understands crypto. I find it hard to imagine, as a taxpayer myself, feeling like I could go to like a TurboTax Live and speaking to somebody there and handing over just a few 1099 DAs and them knowing what to do with it starting in 2025 and going forward. Because there are so many nuances, like this concept that they're not going to have cost basis on it, or there may be a situation where you're in LA on December 31st and you do some tax loss harvesting at the end of the year, but these are reported on UTC, which is like 8-10 hours ahead of LA.
Yeah.
So it could be the next year that you're actually performing that transaction for the 1099. But it's the prior year for you when you're actually performing that transaction. So many different nuances. We still feel like there's going to be a huge demand for advisors that understand the space and not only understand the nuances of 1099 DA, but you don't have to explain to them what is staking, what is swapping from Solana to Ethereum or whatever it may be.
Yeah.
Actually working with an advisor that understands this space.
And also, if you bought one of the Bitcoin or the BTC or ETH ETFs during the year, you should definitely call Nick because your tax compliance is going to be way worse than you thought it was. But it depends on how much you bought.
Yeah.
So Nick and I have talked about this extensively. So for 2025, from the Legible perspective, we help brokers that need to do 1099 reporting with cost basis reporting. And 2025 is the year that brokers that know their brokers are doing build versus buy decision making. Like, are we going to build our own software to collect taxpayer documentation, calculate and track cost basis, and issue 1099s to the IRS? Because it needs to be implemented by kind of October, November for first reporting in Q1 of next year. So Legible is working with brokers to make sure that if they need to buy software, that we're there to support them with all the different components. There's a lot of companies out there that are writing RFPs, requests for proposals, to build and design software. And this is really the space that a lot of brokers are in, and that's the outlook for 2025.
I think it's about time we have for today. Thanks for everybody who's listened through this entire thing. We hopefully got a lot of value out of it. Hopefully you attend more of these as we continue to bring on other clients, other partners that we work with throughout the ecosystem. And until next time.